As we can see, the euro managed to slightly recover against the US dollar. The same is true about the British pound, which showed steady growth. Everything may change today after the release of the US jobs data. Yesterday, the weekly jobless claims came out better than expected, but markets showed almost no reaction to this news. Apparently, the main focus will be on the unemployment data and non-farm payrolls. Now let's have a look at the economic calendar. In the first half of the day, traders will take notice of the UK GDP data for January. Analysts predict a slight increase of 0.1% after a drop of 0.5% in December. UK's industrial and manufacturing production is forecast to have declined in January. So the upside potential of the pound will be limited in the early session on Friday. If industrial activity in the UK drops by more than predicted, the pound will come under pressure very soon, and the pound-dollar pair will depreciate strongly in the first half of the day. Germany is set to report the data on inflation, which is expected to show a slight increase of 0.8% in February. As for the statements by ECB officials, they may not be of great importance today as markets will be mainly focused on the non-farm employment data in the US. The previous reading was surprisingly higher than the forecast as the number of new jobs jumped by more than 500,000. This time, the labor market is expected to add 205,000 new jobs in February. Then two scenarios are possible. If the incoming data considerably exceeds the forecast and shows a rise of 300 to 400,000, the US dollar will gain ground while the euro and the pound will tumble. This will intensify the bearish bias in the stock market and other risk assets. In case non-farm payrolls turned out to be close to the estimates, the euro will get a chance to develop an upside correction against the greenback. Let's say if the US labor market adds around 50 to 100,000 new jobs, traders may cut the number of long positions on the US dollar, and its European rivals may jump to the upside. In case of a cooling jobs market, the Fed will not need to raise the rate at its March meeting by 0.5% and may want to keep a slower pace of monetary tightening at 0.25%. This will definitely weigh on the US dollar. Meanwhile, the unemployment rate may not have any influence at all today. As for the technical outlook, the euro-dollar pair performed a correction on the 1-hour chart after a deep fall on March 7th. Its further trajectory will depend on the economic reports. A false breakout at 1.0598 will give a good sell signal with a target at 1.0574. If the price settles below this range and retests it upwards, we may see a sell-off wave at the levels of 1.0551 and 1.0527. This will be possible only in case of the upbeat data on the US labor market. If the quote holds firmly above 1.0598 and tests it downwards, it will serve as a signal to go long on the pair. Short positions can be opened at 1.0622 and 1.0646 right after a rebound of 25-30 pips. A false breakout at 1.0574 will generate a buy signal which can bring the price back to 1.0598. It is also possible to open long positions on a false breakout at 1.0551. I recommend buying the pair on a rebound from the level of 1.0527, keeping in mind an intraday correction of 25-30 pips. Speaking about the British pound, the falls break out at 1.1935 amid the release of the UK economic data in the first half of the day will act as a sell signal. The next target is seen at 1.1889. An upward retest of this level will give an additional signal for going short, with the targets at 1.0840 and 1.0804. Buying the pair at these levels will be possible after a rebound, considering correction of 35-40 pips. You can also go long on the pair on a false breakout at 1.1889. If the price settles above 1.1935 amid strong UK data, it may head further to 1.1974. However, I think that the upside potential of the pair will be limited until the US reports are out. Sell positions at 1.1974 will be relevant only after a false breakout or following a rebound from 1.2610. Good luck.